Thank you guys for having me here today. Thank you, Mont Blanc, BRAINVEST, and everyone here for making this happen. Really appreciate that. Might have to adjust my height. So before we get started here today, I'm going to mention one thing. I'm not a cybersecurity expert. That's these guys over here. Any cybersecurity questions, these two over here on the far right side, fire away at those. What I'm going to talk about a little bit today is innovation in Silicon Valley, innovation in venture capital, and really the next generation of venture capital as we see it today. And that's what we've done over the past 4.5, almost 5 years now. So starting off, quick legal disclosures. Hope you guys all got that. An overview of who we are today. You may have seen the FCVC Advisors logo. That's the institutional division of Funders Club. Funders Club is the world's first online venture capital firm, and we were launched in 2012 out of Y Combinator. Y Combinator is a premier technology startup hub. If you have their stamp of approval, you're really one of the top technology companies in the world. And to date, we've been focused in Silicon Valley and San Francisco. We have 20 full-time employees. 8 of those right now are software engineers. I saw a slide on Yoav that it says software is eating the world. We view that exactly as the same. We say software is eating VC. And so that's essentially what our mission is to do. It's to find all of the inefficiencies of venture capital from really a couple of the 4 pain points, which is sourcing deals, and not just sourcing them in Silicon Valley and in your backyard, which is great, and we do that all the time. We do about 75% of our deals in Silicon Valley, but there's great deals being started all over the world, and it's not just through Y Combinator, it's through other incubators, it's through friends and families and networks. And so how do you capture that in a very efficient way? We use software, and I'll get into that in just a minute of how we do that. We funded 231 companies in the past 4.5 years, and it sounds like a lot. Again, to enable us, we're using software, we're using a community and a marketplace approach, as well as our full-time venture team. We have 6 full-time venture partners and associates that conduct the standard diligence as a regular VC firm would do. In terms of performance, while we have 231 companies, we're performing quite well. I'll get to that in just a moment, but we've been upper top quartile venture capital performance for every vintage since 2012. What you saw here earlier is FCVC, again, mentioning the institutional arm. Why is that? Why did we switch gears a little bit, or I should say expand into the next category from an online venture capital firm to an offline traditional fund? It was really a direct result and an impact of institutional investors, sovereign wealth funds, pensions, endowments, family offices, my network, and what I was doing before that said, really love what you guys are doing. You're getting great traction. You're getting in early ahead of all of the top tier VCs. We don't want to go online and pick deal by deal and worry about missing the next home run. We want just a traditional packaged venture capital fund. So that's what we did, and we launched that last year. We're also nearing our close for our $75 million offline traditional venture capital fund. And just a quick, I'm going to do a quick, can you guys hear me okay? Okay. I'm going to do a quick brief overview of our team and who we are. Again, we came through Y Combinator. We are a Y Combinator company ourselves. We've actually funded the most amount of Y Combinator companies compared to any other venture capital firm in history. We're at about 140 Y Combinator companies in our portfolio, and we cherry pick the best of the best. So we're not just investing in every single one or spray and pray, as they might say it. We actually cherry pick the best of the best, and we have our performance track record and data that we share with those that are interested, showing that our performance is above the average. First round capital, Spark Capital, Andreessen Horowitz, Draper, Intel Capital, these are all backers of our company. They're also advisors of not only Funders Club, but FCVC Advisors. So they give us a lot of leverage and help in the Valley, as well as around the world for introductions to limited partners, strategic partners, and so forth. A little bit about our team. Again, I mentioned we have 20 employees. I'm not going to go through all 20 of them. I won't bother you with that. But most importantly, those two gentlemen on the left, Alex Maital and Boris Silver, both the co-founders of Funders Club, both serial entrepreneurs themselves. They put themselves through starting a company, raising venture capital themselves. They are Y Combinator back, Wharton grads, very, very smart, brilliant guys. And for what we do here at the office in Funders Club, they are leading the deal sourcing operations. They're part of the investment committee, and they're also managing directors of our institutional fund, FCVC Advisors. And so focusing on those two is really, the gold mine or so. Brilliant guys in Silicon Valley, very, very well connected. Myself there, a little outdated picture. It's actually probably from my wedding about 10 years ago, but hopefully I look a little bit younger there and well rested. Just a brief background as to why I got into venture capital and where I came from. I have a combination of banking, credit, insurance, finance background. And in 2010, I was introduced to this company called Lending Club. Very similar names here, but Lending Club is the world's largest consumer non-bank lender. And I was very, very fortunate to start at an early stage with them when they were young and in a nascent stage of trying to figure out what works, what doesn't work, how does this platform and this marketplace interact, and how do we add value. And one of the things that I was able to be a part of is creating their institutional arm, which was LC Advisors, and quickly onboard sovereign wealth funds, endowments, pensions, individuals that wanted to take a bigger slice but get access to our access at that time, which was, again, fixed income. Why did I make a shift? I think after I left Lending Club, I left pre-IPO. And if you're familiar with Lending Club, unfortunately, it's had a little rocky stage since it went public, but they are turning back around. But I was intrigued by startups in general. Technology, I know, is the next wave of our fourth industrial revolution, and I wanted to be able to access more of that. And so I started angel investing. And as I was angel investing with a small group of friends who we collaborated together, I realized there's a lot of deals out there, and it's really, really hard to find the next winner. And so instead of doing deal by deal, I started looking at other platforms. At the same time, Funders Club was introduced to me, and it was a very easy transition for me to understand that they are a marketplace very much like Lending Club, very much like Airbnb, and pooling communities together to add value at the nth potential for every person they add on the platform. And I wanted to be a part of that. And their track record had intrigued me in terms of joining the team. And so my mission here is really to be a part of VC, scaling it on the institutional side. And why technology? Why does Funders Club, why does our firm, FCVC Advisors, focus on technology? We're technology agnostic, so we're not as fine-tuned into one subsector of technology. We do have cybersecurity companies, but more importantly, what our mission is to say that we're technology agnostic. We want to find the outliers in every single subsector of technology, and that's SaaS, that's drones, that's automated vehicles, that's AI, that's on-demand grocery delivery systems, and so forth. And so we've been able to do that. And how we can do that is what I can get to in a moment. But technology historically has produced the largest returns out of venture capital in general. And for me, I think there's also emotional components of the human potential and the combination of what I should say, drones and robots and robotics, and kind of a hybrid of what you might see here on the left-hand side is a paraplegic that is now able to walk. And that's because of technology. And I just think that's fascinating myself in terms of the abilities that we can do online, offline, and make our human potential better. On the right, what you see here is that's actually SpaceX, their departure and landing. one of the successful lands. So congratulations to them. But this is all part of the companies that we look for. We're not, again, just looking at a particular subsector. We are looking at everything across technology. And what we like about this space really is VC in general, in particular technology VC, is independent of financial cycles. And so what you might have had in pre-subprime crisis here are these pretty unique companies that, well, you're going through the PC era. They were a little bit early on, not so much Amazon. They're still doing quite well, but maybe a little bit earlier on to experience the full embrace of technology and the power of the internet. I mean, we all have this supercomputer in our pocket now. 10 years from now, I'm guessing we won't be holding something like this. And some of the technology companies we're actually investing in now, you don't need one of these to control the PowerPoint that I'm doing today to fly a drone around. It's actually something that'll be on your arm, implanted in your head, on your head. So it's quite fascinating, and I'll go to that in a second. But what you see here is the internet is coming out through its the gestation period is just getting started into a whole new era. And so we have the internet era that is really getting into full motion with mobile phones expanding all over the world where they haven't been before. And so what is this next gestation period? We don't know. And you all have mentioned a couple of really great examples. Is it drones? Is it virtual reality, augmented reality, AI? We don't want to predict that because we don't want to miss that next bubble if we're going 100% in one direction and it happens to be another. And so we cast a very wide web. And we want to be able to capture companies like these. And without venture capital, these companies would not have been as strong as they are today. I found this slide quite fascinating just to give you an idea of why technology. Just take a look at the market cap and the top companies, which is really how people viewed the world at that point and which companies were powerful. There's only one technology company there in 2006. Fast forward today, the top 5 are all technology companies. So it's really taking over the world. And while this might be a short phase, I'm betting that this will probably continue for the next 10 to 20 years. The issue, though, is most tech companies, most returns in tech, even though they are producing the highest returns, they're all private. So if you were to get into Amazon back in 1997, they went public at less than $500 million. There's a ton of upside after they went public. So it's okay if you were back then in 1997 to wait until a company went public to really understand that there's a lot of value add after they went public. That's no longer the case. Sorry to call out Twitter, Mike, but these late stage companies now, technology companies in general, are delaying IPOs, and the value creation is really just being added for those that are private shareholders before they go public. And so we like this in particular because we get in really, really early, and we get in at the seed stage, late seed stage, which was 10 years ago, Series A. And so to be able to tap into any of the returns here, think of Uber, think of Airbnb, tens of billions of dollars in valuation, they're still private. And so the early bettors they're going to be very, very wealthy. They're going to be billionaires. But if you wait too long, you're going to miss the boat. And so we want to get in early before that value creation is eliminated. VC in general, it's really a game of outliers. We're not going to try to assume that out of our 231 companies that we have in our portfolio are all going to be winners. They're not. While we're focused on finding an outlier in every subsector of technology, and we feel we are doing that, we're doing really, really well, but the vast majority of them are going to fail. But the overall portfolio is what you want to focus on and capture those outliers very early on. And one example that you have in terms of also kind of going back into timing, if you were to get in at App Dynamics, which was acquired just literally hours before it went public, it was an odd scenario, but if you were a Series A investor, not even a seed investor, your return was 104x. This is pretty phenomenal. So you took a bet early on to get that return. If you waited all the way until Series F and you knew the company was going to go public, you have a shorter horizon, maybe you wanted a little bit more liquidity or a safer bet, you're going to get a return, but it's going to be very minimal. And so for me, for us, we like to bet early on and look for those 30, 40, 50, 100x. You can't get that if you're a later stage. And I touched on VCs being, in general, just outlier companies. You're going to have this very long tail, and so a few companies in the portfolio are going to hold up the entire performance. And I'll skip that really brief, but what does it look like early on? And so have you guys heard of Airbnb? I'm just going to throw that out there. They had an extremely challenging time raising capital, almost went under. The co-founders were selling cereal boxes just to stay afloat to their renters. And at the time, it really seemed like a bad idea to rent your couch out to a complete stranger. And I didn't understand that. I didn't agree with that whatsoever. It just didn't seem like a good idea. Didn't seem like it was going to get a whole lot of traction. If it's a really, really good idea and everybody thinks it's a good idea, everybody wants in, it's actually probably not a good bet because everybody has already thought of that. So what a good investment is somewhere right in the middle where it's not a good idea or it is a good idea, but we have to find that out very early on. We have to place a bet before it actually becomes an outlier. So if you're waiting again until that later stage, you've already missed the boat in terms of performance and returns. And so that's what our company does really, really good at. We get in early. An example of getting in early, just on a $250,000 investment for Airbnb, you're looking at a $4 billion return net of carry. And so that's an example, again, small investment, getting in early, massive returns. That's technology. You can't do that in any other space. So again, kind of where I touched on is where Funders Club and FCVC feels is that the VC model, VC works really well. VC's been around for decades. It's the way that everybody's been doing business. But it is slightly broken. It is inefficient. It's outdated. Most of the documents we see going around the valley are the same documents and term sheets that have been around for decades. And so we're here to use technology and software and really get that next generation VC and give them a boost. And what I had mentioned earlier is we find outliers early, and we're not just bringing capital to the table. Also, another thing that I should mention is we're not leading rounds. We're not big checks into companies. We like to add a lot of little checks into companies to get access into them. As they become outliers, we can then double and triple down on, and I'll get into that in a second. This is, well, this looks like a lot of dots. That's actually a map of the world. And so I apologize, it didn't come through very clearly, but this is the United States. This is North America here. And so if you can get a visual, we have an online network of accredited investors, which in the US, it's by definition, these are wealthy individuals, typically of higher class. They have connections, they have their own network. They're C-level executives, founders, advisors, and so on. Very, very well-connected, high, powerful people, but not necessarily ultra-wealthy billionaires per se. Some certainly, but not all of the case. But nonetheless, we are able to use that and leverage our network effect of those members and use them as deal scouts. So I mentioned earlier, we have 6 full-time venture capital employees. They conduct diligence, they source deals, they go to all of the demo days just like any other VC does. In addition, what we do is we leverage this 19,000 group of our members worldwide in 63, actually now 72 different countries. And that's actually enabled us to invest in now 231 countries. 231 companies across 19 different countries. So these areas, we've invested in companies in Brazil. We have some of the LATAM companies would be Rappi, Pipefy, Trocafone. There's about a dozen companies that we've invested in LATAM. And what's unique about that is a lot of the companies we get are referrals from our network base. So we're seeing them before any of the other top tier VC firms in Silicon Valley are seeing them. We get in early. We get in at a lower, more attractive valuation, I should say. And then we introduce them to the Sequoias, the Andreessens, the Kleiner Perkins of the world, and then they get bubbled up and carry on from there. And we have very strong relations with other VCs in the Valley. So again, this is showing a map of the world of our investments. So we do have a global reach. About 25% of our companies are outside of the US. Here's my software is eating the world. Funders Club is eating VC. And that's exactly what we're doing. Wall Street Journal did an analogy very similar, and they compared us to Google and how Google got started. And so what we find fascinating is we have an online ability, again, of this community, 19,000 members. There's a lot of data that we're able to collect from the interactions of those members, from the thousands of deals that we look at every year. And we can track that, we can monitor that, and our data scientist is constantly creating algorithms that best fits where we should be focused on, where the trends are, and we can get it ahead of time and not wait for something to pass us by. And so we're using software, our network effects, and the data to get the best returns and outcome in our companies. I mentioned before, we're not a spray and pray company. We don't invest in everything. We have an extremely tight diligence process for a company to actually get through. We only approve about 1.5% of the companies out of thousands of companies that we look at every year. I don't want to dig through our investment process here too much. I want to be mindful of everyone's time. But one thing I will highlight out is we have our investment committee, as well as in the final due diligence stage. That's our full-time membership. And I'm running out of time here, so I'm going to quickly go through. Time-tested criteria that we have is consistent with other VC firms. We have unfair advantage in terms of network effects and value add that we bring to our founders. It's more of like a LinkedIn and professional data for their own side. Our returns are transparent. We're very transparent. That's another thing that we're bringing to the game. As I mentioned before, we are upper top quartile VC, 49.2%. Net IRR for our 2013 vintage. We've had 1.7 billion follow-on from all the top tier VCs that you could want to partner with in the Valley. And we have about a 30-to-1 ratio in terms of our investment for $1 in, $30 it get followed on by top tier VCs in the Valley. Real brief, again, I know I'm running on short on time. Instacart is one of our outlier companies. They just raised around a couple of weeks ago for $400 million led by Sequoia. We invested early. Again, this is an example where we got in at their $5 million valuation, a seed round, and we then also followed on because we have great bonding relationships with all of our founders. We were also able to get into their Series D round. And so we can do that for our clients as well. Coming into our vehicle, our fund, some of our LPs, the family offices, view us as an access point to our network or our portfolio of 230 plus growing companies for later stage investments if you really want to concentrate on some of the winners. Slack's portfolio company of ours, you may have heard of them, fastest growing enterprise software company. Thalmic Labs is the gesture control company that I had mentioned that we no longer need one of these, a mouse or a keyboard to control computers and electronics. Coinbase is a very fast-growing Bitcoin wallet. These are all companies of ours. These are all investments that we made early on in their seed stage before they were actually outliers. We have a track record of performance. We already have 18 exits in the portfolio. We've only lost, or I should say dissolved about 6 companies. And of those 6, we're pretty much at break even. We've got most of our capital back. And happy to talk to everybody a little bit later. Again, just short on time if you guys are interested in learning more. And I know we're going to be doing a questions and answers section, but I'm happy to talk about our historical performance, our upcoming fund, where we see VC going in general, and then our fund thesis, which again is going to be targeting a third of our capital into early investments, seed stage and Series A, and as we see those outliers pop up, 2/3 of our investments are going to go into follow-ons, really doubling, tripling down on the winners. And all I can say is, again, thank you very much, obrigado, and I'll be around for you guys. Thank you.